What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of July 2023. In each episode, I try to find you guys 3 new stocks that I think are trading on sale for the long term. These are stocks that are heavily beaten down, could potentially present some value here for the long term. And to add a little more variety, I specifically choose one low risk, one medium risk, and one high risk option. I will just say though that in the current state of the economy and the stock market, it's pretty hard to find anything out there that doesn't carry significant risk. Stock market is up a lot this year and the economy is still in pretty bad shape. Inflation, interest rates, possible looming recession, all kinds of issues out there. So please, as always, just keep in mind, I'm only trying to throw some different ideas at you guys. I'm trying to pick some stocks here that are, in my personal opinion, could present some good buying opportunities for the long term. But you should always do your own research and make your own decisions. Don't ever copy what someone else is doing. We all are different investors. We all have different strategies. It's impossible to know what stock fits, someone's risk tolerance and preferences and all that kind of stuff. So just always do your own research, make your own decisions, goes without saying. Now, if you do want to find a place where we can share all of our different investing strategies and ideas, a great place for that is our community Discord, which you can get access to by supporting me on Patreon, and that means the world to me. Thank you to everyone who has signed up on Patreon. It really helps keep this channel alive, and it just means a lot to me. So thank you for that. But with all of that said, we got 3 stocks to run through, guys, 2 of which are stocks that I almost have never talked about on the channel before, so it's going to be a ton of fun this month. But let's not waste any more time. Let's go ahead and jump into the 3 stocks for July. Okay, now while there is a lot of risk out there in the market, one stock that I feel is at least lower risk than many others is Tyson Foods, ticker symbol TSN, which is a stock that I actually have barely ever talked about on the channel. But this is not only a dominant market leader with a fat dividend, but it's also a stock that has been heavily beaten down this year as well. In fact, when looking at the top 100 meat and poultry processors, Tyson ranks as #1 in the United States and usually in the entire world too, depending on what specific markets you're looking at, especially in poultry, where they consistently rank #1. And this is largely due to their wide array of popular brands like the namesake Tyson, but also Jimmy Dean, Hillshire Farm, Sara Lee, Ballpark Franks, and several other iconic brands as well. The result of which has been very strong and relatively stable financials over the years. Now, granted, revenue growth is plummeting from a double-digit rate last year down to just the low single digits these next couple years, with profits also taking a bit of a hit here because of a number of macroeconomic issues, most important of which is the crashing price of meat and poultry right now, which some estimates have shown staggering drops of like 8% in beef, 15% in poultry, and a gigantic 70% in chicken breasts in certain recent months. The thing is, though, that the protein market is highly commoditized and can therefore be quite cyclical. And to add on to that, the recent waves of inflation and deflation with all the manipulation, being caused by the Fed, you're really left here with some huge headwinds and a lot of volatility. In fact, last quarter, Tyson CEO said that this was one of the first times in the company's history that he's seen pricing pressure across virtually every single meat type that they sell. And as if that wasn't bad enough, feed costs for all that cattle, for all that stuff, the feeding costs are also at the highest that they've ever been in history. So you now have weaker sales with higher costs. I mean, that's a recipe for disaster. But in my opinion, most of this should already be priced into the stock, as it has now fallen from over $100 a share down to just $50 today, losing more than half of its entire value. But as you can see on this chart here, the stock is often cyclical and it tends to find a huge amount of support around this $50 mark. On top of that, their dividend has now risen to the highest level that I've ever seen in it at almost a 4% yield, with also some very solid growth metrics on it too. Valuation wise, it's a bit of a mixed bag because of the recent headwinds, but if you look at trailing profits during normal conditions, the stock actually trades right now close to 50% cheaper than the sector on on a trailing PE ratio of only 12. That's very low. And prices sales is even cheaper than that at only 0.3 trailing and also forward. That's almost 70% cheaper than the sector as well. And when looking out into the long term, I just don't think the meats market is really going anywhere. In fact, analysts still project low single-digit growth in the coming years, which is the same growth that Tyson is seen as the leader of the market. And when you look at what trends analysts are predicting will see the most growth, they point to things like frozen and air fryer ready meats for convenience, as well as plant-based meats as alternatives for vegetarians. Well, Tyson has already doubled down on all of those markets greatly. If you go into really any frozen food section of any grocery store, you'll find tons of Tyson products, many of which are labeled as air fryer ready, convenient packaging, all that kind of stuff. Plus, they've been launching new plant-based burgers, hot dogs, and other meats as well. And I think that's why you're seeing EPS growth estimates still coming in at the same rate over the next 5 years expected as the previous 5, despite all of these massive headwinds. There is for sure a lot of risk here because of the macro headwinds, but in my opinion, I think there's risk with just about any stock out there at this point, and Tyson remains a market leader here that I think isn't going anywhere. Even if we were to go into a recession, I know that's on a lot of people's minds these days. I mean, Tyson's products are usually very cheap and affordable. I think they would actually do fairly well during a recession and certainly survive it and come out stronger on the other side. And just kind of looking at the stock historically speaking, anytime that it's traded around these levels was always a great pickup. So I think the stock is looking very attractive at this point. It's not one that I own yet myself, but it is very high up on my watch list, and I may be picking up just a few shares here very soon. Maybe just start a small position on it. If it continues to fall, I can add to it over time and build it up that way. But yeah, it's very tempting. I'm probably going to end up owning it very soon. All right, now moving on to our medium risk option. This month, I'm going with another stock here that I do not currently own yet myself. In fact, I've rarely ever talked about it on the channel, but it is getting extremely tempting to pick this one up. In fact, it's one of the stocks that I get the most comments on from you guys that tell me that you're all buying it and that you want me to analyze it, you want me to give my opinion on it. So, all right, asking you shall receive. We are going to include it in this month's video. That stock is going to be PayPal, ticker symbol PYPL. And I gotta say, I agree with the people that have been leaving those comments, because this is much more of a growth-oriented fintech, and they provide digital payment processing services to both merchants and customers, and then they collect fees from each transaction. Well, PayPal is also the primary payments partner of eBay, the massive online giant, who they were actually spun off from many years ago, and they also own the subsidiary Venmo, which has been a very popular app to use, especially in America. Speaking of America, PayPal completely dominates the American market with almost 60% market share in the payment service segment, while also controlling over 40% market share around the world as well. The next closest competitor is Stripe at only around 20% or less. Now, I will just say though that when you look up market share estimates for PayPal, almost every analysis website out there conveniently ignores other giants like Alipay, WeChat, Apple Pay, Google Pay, and others. And the excuse that they usually give is that those services are either a little too different to compare, or they only cater to a specific market or segment, or even a demographic like Chinese people. But regardless, the point is that PayPal is a very large and very dominant business in their specific segments, and that's led to a lot of financial success over the years, especially during the pandemic, where sales skyrocketed by around 20% or more thanks to a rise in online shopping and people staying home. The issue, however, is that we are now coming off of the pandemic with a horrible macroeconomy, and so the revenue growth is plummeting down to a high single-digit rate, with GAAP net income also taking a big hit. But in my opinion, and very similar to Tyson here, I feel that this may be setting up for one of the best kind of buying opportunities in the stock's history, as it has now crashed into the ground, falling from over $300 a share all the way down to just $65 today. That's a monumental crash of 80%, and it's leaving the stock now trading even lower than their pre-pandemic levels. And yet, we know that sales have actually soared during that time, with next year's projections at almost double their pre-pandemic size. We also know that free cash flow is still near an all-time high and way larger than their pre-pandemic size, which I also feel is a better measure of profitability. We know that the mobile payments market is still growing by huge amounts of over 30% a year and is expected to reach close to $20 trillion by 2030, which presents a giant long-term opportunity for PayPal, even if they're already the largest in the market. And because of that, analysts are still expecting about the same EPS growth over the next 5 years as the previous 5. So I'm just not really sure what I'm missing here. The valuation has now sunk down to a forward PE ratio of only 13 with a PEG ratio of only 0.5, while the sector median is more than double that at 1.2 and their own 5-year average is 1.9. So PayPal is looking extremely cheap by that comparison. And that's why they've even decided to buy back $5 billion of their own stock this year after selling many of their buy now, pay later loans to KKR. Yes, there are major headwinds at the moment, and that's why their user base actually declined a little last quarter, but they still have over 430 million user accounts that are just as active and valuable as they've ever been, with transaction activity actually increasing by 13% regardless. I do worry about how much competition they face, and I also feel that if we do go into a recession, they're going to take heavy damage as a fintech. However, at these prices, at these levels, I feel that PayPal is one of the most attractive kind of high risk, high reward options in the entire stock market. And I may be picking up a few shares myself very soon. It's looking very attractive, especially if it continues to fall like this. Alright guys, that's going to leave us now with the third and final stock of the list, which is also our highest risk option. And what's funny is that even though this is the highest risk option, it's actually the only stock that I've already been buying this year myself. But that's going to be the pharmaceutical giant Pfizer, ticker symbol PFE, which I do consider to be higher risk because they're the only one on here that is actually seeing their sales decline and by a huge amount. But despite that, I actually think that Pfizer stock is a pretty high quality and market leading dividend payer that has been beaten down into a cheap valuation with still a very large amount of future potential. And at a time when the overall stock market has actually climbed this year, Pfizer stock has instead crashed by almost 30% year to date and is also down over 40% from its highs. And the thing is that most of that crash is really due to the declining sales of their pepperoni V-Shot as we move past the pandemic and demand continues to fall for it. And look, I'm totally fine with Pfizer stock crashing because of that. I think it was too high to begin with for just a single product alone, and seeing overall sales falling by 32% expected this year, I think that completely justifies the recent pullback in the stock. I mean, that's a massive fall in terms of their financials. However, where I disagree with Wall Street's valuation of all this is that they're forgetting just how much money Pfizer has already made from the pandemic and that they've been using to invest in future growth initiatives to maintain their gigantic size and dominance, leaving behind what I feel is a grossly undervalued stock. For example, the bleeding is expected to stop next year when they stabilize and slowly return to growth, which at that size, they are still going to be close to a $70 billion biotech in terms of yearly sales, which is not only close to double the sales that they did before the pandemic, but it would still be enough to be considered the absolute largest biotech pharmaceutical in all of America and almost the entire world too. In fact, the only public company that would technically be ahead of them is Johnson & Johnson, but they do way more than just pharmaceuticals. And when you exclude for that, Pfizer would actually be ahead of them too. And that also includes other giants like Merck, AbbVie, Abbott Laboratories, Eli Lilly, and more. Pfizer beats all of them. And a big reason for that is because Pfizer is arguably the most aggressive takeover company in the sector. In fact, they've used their gigantic profits from the pepperoni to acquire Reviral for over $500 million, Trillium for over $2 billion, Global Blood Therapeutics for over $5 billion, Arena Pharmaceuticals for close to $7 billion, Biohaven for more than $11 billion, And most recently this year, they just announced yet another massive acquisition, this time of Seagen, which is worth over $40 billion, and it would give them control of innovative cancer treatments, some of which are already very high selling, while others recently gained regulatory approval and could be a huge boost to their future financials and help bolster up their already massive pipeline of future drugs and treatments to help them lower their dependence on the pepperoni V-shot. And yet, with all that market leadership and all the aggressive acquisitions in mind, Pfizer stock still trades close to 50% cheaper than the sector on a forward PE basis. And that's forward PE, by the way, meaning that it includes the expected crash in sales and profits, and yet they are still incredibly cheaper than the sector. And not just that, but the fall in the stock price has also raised their dividend yield all the way up to over 4.5%, which is super attractive. Granted, the financials will take a big hit, and they're also spending a ton of money on acquisitions, so it may not be the safest dividend out there, but with over a decade of consecutive growth and a pretty low payout ratio of just 26%, I would actually be surprised if they did decide to cut it. Again, I totally understand why investors are selling out of the stock. It can be very scary to invest in a company that is seeing their financials take such a huge hit in such a short amount of time. And even Pfizer themselves have some controversies that are like company specific, depending on, how you feel about the pandemic or the V-shot or of other things. Everyone has their own personal opinions on all of that stuff. But I just think that from a stock investing perspective alone, just looking at the stock, I feel that Pfizer is making some giant moves here that nobody seems to be talking about or maybe even noticing. And I think what could potentially be left here is a very beaten down, severely undervalued stock, but a company that could still be a extremely dominant, very large market leader in the future with lots of other potential, and that also pays a very nice dividend. So we'll see. I think it has a lot of potential. It's why I've purchased the stock myself, but time will tell on this one. It's a bit of a mixed bag. I think it's high risk, but there's also potentially a lot of value in it too. So anyway, those are just my thoughts. What do you all think? What moves have you all been making over the past month? What stocks do you think are looking attractive right now? Do you agree with any of the picks I made? Would you swap them out with anything else? Let me know down in the comment section, because I may include them in next month's video. But thanks again for stopping by, my friends. I really appreciate all the support. It means so much to me. I hope you're all doing well, and I wish you the best of luck with everything, but I'll catch you in the next video. Take care, everybody. Bye-bye.